Entrepreneurship is like mountain climbing. It feels good because it's super hard. When you get to the top of the nearest peak, you just feel good about accomplishing something super difficult.
It's probably after you hit the peak, then you're looking for another mountain to climb, right?
Because that's like mountain climbers. They go back down and do it again.
I'm thrilled to welcome Charlie Youakim, co-founder and CEO of the BNPL platform Sezzle.
We better raise some capital fast because we got some really big competitors. Klarna was multi-billion at that time. And then Affirm, they launched, and then PayPal launched. We were like, my goodness.
How does Sezzle make money?
We charge retailers 6% plus 30 cents. We increase your sales, we increase your basket sizes, we increase your conversions. These merchants are making like 40, 50, 60% gross margins. So they're like, yeah, give it to me.
The buy now, pay later market is quite small compared to other types of commerce. Do you see that continuing to grow?
Really just kind of view this as like a new way to pay. The debit and credit was the old way to pay. And it's basically just driving a wedge into that payment pie. And I think the pie is still expanding. And I think it's going to expand for the next 7 to 10 years still.
Are there any kind of go-to places you would say is worth looking at if you're looking to kind of get into fintech or having a startup?
I would probably look at...
Hi, this is Matt Cheung, founder of Work in Fintech. And today we're delighted to be joined by our guest Charlie Youakim, who's a serial entrepreneur, CEO and co-founder of Sezzle, which is a multi-billion-dollar buy now, pay later fintech, and also previously was a founder of Passport, a payments company for the transport sector. So Charlie, great to have you with us today.
Thanks for having me. Appreciate it.
So we always like to kind of go back to the roots and understand before you became a CEO. What was your journey before that? Kind of were you a coder when you were a young kid? You know, what type of place did you grow up in, and how did you end up getting into fintech?
Well, probably an unusual. I'm not the lemonade stand kid that was dreaming about being an entrepreneur his whole life. I grew up fifth of 6 kids. Probably lower middle class family, but when you're growing up, you don't realize it. You think everything's great. And then I loved science, loved technology. I also loved gaming. So I was a nerd, I was a gamer, played a lot of strategy games, etc. And then I went to college for mechanical engineering. I think mainly because I just liked science and liked learning how things worked. And I went through school doing that, really enjoyed all the classes. But then when I finished it, didn't really know what I wanted to do in engineering. And I was a tinkerer. I was building my own computers, making web pages and so on. This is the start of the internet. This is 1995 and 1999. I'm just so early in the start of the internet. I went to the University of Minnesota, and my brother-in-law, who went there before me, got me a job at the Internet Helpline. This will tell you how early internet it was. I worked at the Internet Helpline. When I took over, I took my shift, there was one person working there. I would grab the phone from him and take over. And the red light was like an hour deep of people calling. It was starting to explode. This is 1995, 96. And then when I finished my college career in 1999, there were 20 people answering at the same time on that same internet helpline. And I basically helped train them all in, because I was one of the first in there. So I started kind of on the burgeoning of the internet and did a little bit of tinkering, software development. And so actually, instead of going into engineering, I went into software development for my first job. And in the parking industry of all places. And so really, got into parking, got into that industry, really in just, first job. I wouldn't say I was like a go-getter, my first job. I just was kind of I was very successful in school, but then when I got into my first job, I started getting paid. I think I just enjoyed going on Friday nights and having fun with friends, playing softball, playing games, dating, whatever. And then I realized a few years into it that it didn't feel as good as I wanted it to feel. It felt a little hollow, and I was like, I want to go do something. I want to do something special. So I went to business school to kind of get a career change moment. That was after 7 years doing engineering or software development. So I went to business school back at the University of Minnesota. And out of business school, we had the global financial crisis. And it was actually hard to get an internship. Even though I had really good resume, background, et cetera, I couldn't even get an internship. And I was talking to my cousin at the time. We both wanted to start something. And we had no one in our ecosystem of family, friends that had started companies, but we wanted to do it. We just thought it would be kind of cool. And I viewed the GFC, the global financial crisis, as my push out of the nest. Because I couldn't do anything else anyway. So it's let's do it. And so that's when we started Passport. And that was really kind of the early winding journey to get into entrepreneurship. And I'll tell you what, it was the best decision I ever made. And, really changed the attitude. Like, when I was in my young 20s, it was just like, grabbed a paycheck, low bar of success in the company. I was getting high fives, but I wasn't feeling very special about what I was doing. And then now I always talk about, I don't know how you feel about it, Matt, but I always think about entrepreneurship as like mountain climbing. It's like, it feels good because it's super hard. And when you get to the end of the journey, there's really no ever end. But when you get to the top of the nearest peak, you just feel good about accomplishing something super difficult. So when I finished Passport, I just wanted to do it again and move on to Sezzle. And that's, how I started Sezzle.
Yeah, the climbing analogy is a good one because probably after you hit the peak, then you're looking for another mountain to climb, right?
Totally. Because that's like mountain climbers. They go back down and do it again. Same thing.
Yeah, and I guess most entrepreneurs are like that too. When, if they do exit a company, they straight out and do it again.
Totally.
So Sezzle, when you first started that company, was that with someone you went to university with?
Exactly. So yeah, after I left Passport, I'm always the tech side. Well, there's two companies. So when I start a company, I'm usually the tech side. And so I always look for the BD side kind of partner. And at University of Minnesota in business school, I met Paul Paradis, my co-founder. And he's more on the sales BD side of things. And we just got along great. And not just, some people can kind of think this is funny, but like in school projects, you have some pressure. And that pressure can crumple people and you see true colors, or some people rise to the occasion. And Paul, whenever I worked with him, he rose to the occasion. We got along great on projects. And so I was like, we even were friends outside of just school. Like, so I was like, I think Paul would be a great partner, like in doing something like this, and fantastic decision to reach out to him. And then that's basically how we started the company. He said he was at a point in his career, he wanted to do something different. I was looking for someone I always think it's nice to have a co-founder. I just think it's like, partner in crime to bounce ideas off of and go after things. And so I found my partner and the rest is history with Sezzle. Not an easy journey, but it's really important to have a co-founder that can help you along the way.
So when you started Sezzle, then you came with knowledge from Passport and the trials and errors and so on that you learned from there. So can you talk about that, and can you also talk about then what was the problem you were trying to solve initially with Sezzle?
Yeah, so at Passport, lots of trials and tribulations. Basically knuckleheads starting their first business. They don't have a first clue about what they're doing. A funny story. It may not resonate with like worldwide audiences, but I'll try to relate it. I still remember this story. We started to get traction at Passport. So Passport, we did mobile payment apps for parking at first. Actually, the first idea was parking hardware, but we got out of that in a hurry because we didn't have the capital to build hardware and it was too slow. So we decided to go into mobile payments. And we started to get traction. I think we're close to signing the city of Chicago on a big deal. And so we got our first official office. Before then, we were working out of a house. I was living in the wing of the house and walk into the living room, and that's where our office was. So the city of Chicago said, you better get out of that house if you want our contract. And so we got an office. But I remember sitting in an office we were developing, and some guy ran out of our office, in a fury, like some new hire. He was all pissed off, and he said, and you guys don't even do I-9s. And I was like, I-9 in the United States is a form you're supposed to file the moment someone starts with you to register them as with the tax system, I believe. And when he walked out, I was like, what's an I-9? And I didn't even know what an I-9 was at that time. But now there are tools that help you with that, like Gusta was the one we used at Sezzle. But yeah, you were basically, at Passport, we were learning everything from the start. And, we were
taking out the bins, doing the accounts, doing the sales, doing the cold calls, going to get some milk in the shops. Yeah.
Totally. Cleaning the toilets. I even did that to start at Sezzle, do everything. I actually kind of enjoy doing a lot of those things anyway. But we were doing everything. But, a lot of the big learnings I'd say at Passport were, here's one example. We were talking to every fundraising round kind of venture capitalist. We were talking to Series C, Series B, Series D. And I realized afterwards, how dumb that was. What a waste of everyone's time. And I think, some of these analysts would take the calls with you because they just get deal flow and they get a KPI they hit, so they'll take the call. And then you realize afterwards, what a waste of time. So basically, I think most of the things I learned at Passport, and we've created a successful company. But most things I learned were like how to cut the corner, how to like not do that, and that, save yourself 80% of the day so you can make your days 5 times as productive and get there faster. And I got to tell you, Matt, thank goodness, because the Sezzle ecosystem of competitive companies was another level. Like I can call Passport like the minor leagues, and Sezzle, the competitive scope of like companies we competed against, major leagues. And thank goodness I had the experience from there to bring into Sezzle. Otherwise, I don't think we would have been successful. There was just too much good competition at this level.
And so what was that competition at the very beginning then? What were you doing at the start?
Well, so the start, again, we had the wrong idea. I'm 2 for 2, wrong idea at the start. We were trying to do like, I call it like a Venmo for checkout, which may not resonate worldwide, but Venmo is like our P2P tool in the United States. It's you pay from your bank, when you pay your friends. And we were trying to bring bank payments to checkout to lower costs for merchants, because I knew that ACH or bank payments are very cheap. What we realized, we launched the product, it wasn't taking off. And we said, just like at Passport, what's working? So we're looking around the industry, this one's not working as well as we wanted to. And we saw BNPL taking off in Australia. So BNPL paying for, short duration installment loans for, transactions at checkout, like $100 checkouts. It was taking off in Australia with a company called Afterpay. And so we said, that looks really exciting. I'd been to Australia for Passport because we were thinking about expanding there. And I kind of viewed it as like a USA South. If it's working in Australia, there's a good chance this thing will work in the US because the cultures are so similar. And so we pivoted in May of 2017. We launched originally in January or February of 2017 with the original idea. It wasn't taking off in 3 months. So in May, we decided to pivot. In August, we relaunched with the buy now, pay later product, and then it just took off. The problem was it took off with Australian merchants, and Afterpay was a $2 billion market cap at that time with really good founders. Anthony Eyes and Nick Molnar, really sharp. Every one of these founders we were competing against were really good. And they had a lot of capital, a lot of clout. And so they noticed us because their merchant partners were their friends. They were close contacts. So they said, hey, there's a company, Sezzle, launching in the US. You might want to get busy. And the Afterpay crew knew that they had to get busy. They came in and competed us right away. So think about this. People always wonder, like, Sezzle, how do you compete with these bigger companies? I'm like, the ratio is way better today than it was before. Back then, we were like a $20 million company competing against a $2 billion company. And they were competing with us right away. A company called QuadPay with 2 really good founders. It started shortly after us, Australian guys as well. Klarna was aware of the product launch in the fall of that year. They came by soon. Affirm came by like the next year and launched.
So what years were these?
Oh, this is like I swear we met people at Klarna in 2017 as well. So we launched our product in August, and I think in that first fall, or maybe like the first 2 quarters, we met most of the groups that were wanting to enter the market. And it was, the Klarna was multi-billion at that time. They were probably bigger than Afterpay at that time in terms of market cap. And then Affirm was probably smaller than Klarna, but they were US based. They launched shortly thereafter. And then PayPal launched. So it was like, we were like, my goodness, we better raise some capital fast because we got some really big competitors. But we did have a niche that was really taking off for us, though. We were really good at small to medium-sized businesses on Shopify. We were like a machine. And that, I think, helped us a lot because those small to medium-sized businesses, which, by the way, that's one recommendation I always give to new entrepreneurs, Matt. And you mentioned that's the audience here. A lot of the first-time entrepreneurs always want to go after the big clients, which I always think is a death sentence at the start, because they always want to tell you, they always want to be nice to you, and you think that they're giving you a chance, but the right target is the SMB merchant more often than not, because they'll really give you the chance, and if you make a difference for them, they'll give you feedback and give you quick iterations. But we became like just superstars at SMB and a machine. And that's what really helped us compete against a lot of these big players.
Can you just break down buy now, pay later again for people who are not familiar with it?
Yeah, sure. So the product, it's a unique new product in the financial systems ecosystem. That before buy now, pay later, people paid either with a debit card or a credit card. So straight debit, straight credit. There was some installment financing going on, but it was like monthly installment financing for furniture, for, washers and dryers, appliances. And so what BNPL was, it was a short-term, in a way, of reverse layaway. So you're on a site, you'd see, hey, this sweater's $100, or 4 interest-free payments of $25 with Sezzle or with our competitors. And then the customer would click on that information box and be like, what is this? And it would basically show the schedule, and the schedule was very short term. We take 25% today, and then we schedule out automatic payments at 2 weeks, 4 weeks, and 6 weeks for the customer. And then when they see that, they're like, that's a perfect product for me, because the customer tends to be like a younger customer, mid to low income, new to credit, and they get paid biweekly in the United States, typically. In a lot of countries as well. So they get paid biweekly, so the biweekly payments match their income stream. So they viewed it as, I think in many cases, they and still do, view it as budgeting. I don't have to think about this thing. I can just buy it. It'll automatically draw from my paychecks or on my paycheck schedule. And what that did was it pulled forward the transaction for the merchant. So the customer might have been looking at a sweater saying, I like that sweater. I'm going to come back. But here's what merchants know. Only like 5% of customers come back because they get distracted by the other $100 thing between now and the next 6 weeks. So we pulled forward purchases for these customers, made massive differences in conversion and sales for the merchant partners, and then it proliferated the merchant ecosystem rapidly. Because merchants, here's what happened to the merchants. They'd either tell their friends how well it was working. They didn't even need to do A/B tests, Matt. There was no A/B test needed. It was so dramatic that they were telling us, wow. Like we had some merchants where we were 40% of their checkout, like after launching. Not all, but a good.
And then so how does Sezzle make money? Do you charge on interest on those installments, or you charge the retailer for using the service?
The retailers. So the model started, it's evolved, but the model started, we charged retailers 6% plus 30 cents. Typically in the United States, it's 3% plus 30 cents. So we said it's inclusive of processing. So it's just basically just 3% more. We increase your sales, we increase your basket sizes, we increase your conversions. And these merchants are making like 40, 50, 60% gross margins. So they're like, yeah, give it to me. Put it on the site because this is helping me a ton. And so what would happen was they would put it on quickly. They'd see the great results. They'd tell their friends, their other friend merchant partners. They'd reach out to us and our contemporaries. And then the competitors in the space of those companies would see it advertised on the site and say, what is that? Why does my big competitor have that thing on their site? And they would reach out to us to want to learn more. So we basically we went from outbound to inbound rapidly with merchants. And
so product market fit at that point.
Yeah, totally. It was perfect product market fit. So at Passport, we had this great, nice growth curve. At the launch of Sezzle, I told the team, I'm like, this is where I think having a prior startup helps. I was like, I've seen nothing like what we got going on right now. I mean, we were rushing to fundraise because we almost had to. We were growing so fast. So we had to go fundraise as fast as possible. So
is that when you IPO'd?
Exactly. And that's another unusual kind of path we took. This is a very unusual path company. So, well, first, I had a really kind of fortuitous situation happen for myself and for the company. I exited Passport during this time period, took my exit and rolled it straight into Sezzle, which basically gave us our Series A funding. Mm-hmm. And then after the Series A, we were still growing rapidly.
What did your did you have a wife at the time? What did she think about that?
No, she did not. I wasn't married at the time. Yeah. And people still think I'm crazy.
You're risk on at that point then.
Yeah, I'm always risk on. So but a lot of people still think I was crazy. But I just knew what was happening in front of my face. I'm like, this is incredible. And so at that point we wanted to keep on fundraising and rapidly. And we were talking to venture capitalists in the United States. pretty limited ecosystem of venture capitalists that would invest in payments lending companies, mainly the lending part. And most of them had already made their bets on Affirm, Klarna, maybe even Afterpay. So we were kind of scoped out, and we had some big competitors. So we were talking to some venture capital firms, but then along the way, one of the analysts, so again, Afterpay was a publicly listed company in Australia on the ASX. So one of the analysts that was covering them wanted to learn more about the US. So I was talking to him. His name's Phil Chippendale, and really good guy. And he said, Charlie, have you thought about fundraising here? You might want to come down and talk to investors because they want to invest in this USA growth. And so it was such an unusual idea, but I was like, I'll go. I did a non-deal roadshow with like 20 funds, and in the last couple of conversations, I was just like, what do you guys think? Would you guys invest in this IPO if we raised $20 million? And they were like, we'd be in. And it was like the last couple groups. And I was like, I came back to the team. I'm like, you guys, I think if we do this, it's going to fly. We're going to raise, which is so unusual. And so we bid, that was back in December of 2018. We started the IPO process the next month. We were listed in July on the ASX. And it was a fantastic decision. Lots of trips to Australia, which is not a bad thing necessarily. But it ended up being a really great fundraising vehicle for us. We raised about 100, maybe 120 million on the ASX. And really worked out well for us because we needed to raise capital rapidly to compete against these, really high quality companies.
So what happens? Because then another year after that was COVID. How was that a good thing for the company? Or was it a roller coaster ride?
Wild times. So even before that, Matt, I mean, the wild times started with, I think before COVID, state of California said that the way we were running our model, they didn't like. We were doing retail installment contracts, and I know I'm getting into the weeds a little bit, but retail installment contracts are the merchant is basically offering the installment plan, and we're just the technology layer for them to do it. But California didn't like it. I woke up, might have been like New Year's Eve or New Year's Day, with a headline that state of California was, attacking us in some way. I can't remember the exact wording. So that was when we had to basically, work with them to get out of the situation. Then California attacked all the other companies, but they attacked us first. They attacked the US-based Runt company. At that time, first, I was like, couldn't you attack the foreign companies first?
Yeah.
But there's a way to deal with that one. And then, in terms of like COVID, which came shortly after, right when COVID hit, I remember our share price like dropped into a tenth of what it was. I mean, big swings in valuations. And then, of course, a month later, with all the stimulus checks and all the recovery, boomed. So, we had these wild swings early in the company's valuation and the company's prospects. And
so what do you think? Because obviously you're a listed company at this point. So did you ever think about, like, if you weren't a listed, because obviously people can see everything all the time because you've got a share price, right? And it's up and down. And is that quite stressful? And are you watching it all the time, or do you kind of try not to pay attention to it?
You basically look at it every day. I do at least. But I don't think, I'm not a seller. I don't really sell at all. But I like to, I watch it. I look at chat boards. I kind of view it as like, when you have a product, you look at the reviews. I kind of view like the chat boards as a review, like a stakeholder and a review too. Like, how are people feeling about us and sentiment? So I definitely look at it. It definitely can affect you sometimes. I'm not going to lie about that. Like, you have to have a thick skin, I think. But if you do entrepreneurship for long enough, I think you start to get a thick skin. It just kind of happens. And so I look at it more as like feedback. I am actually, people always ask, would you do it again, be a public company? I actually really like the public ecosystem. I think you have to be smart about how you run it, a company on the public ecosystem. You've got to have enough capital if you're burning capital, like for 3 years, because you just don't know markets and how they'll react. And I also think that you've got to be really ready to adjust quickly given the scenarios, because downturns can be longer than 3 years. So for instance, we had the unique dynamic because we're a US based company listed in Australia, but we are a U.S. C corp essentially. So we're beholden to U.S. laws, and the U.S. key law for securities was developed in 1933, I mean, a long time ago. And in that law, it said if you have over 3,000 investors, you have to register in the United States and file. Well, it didn't say U.S. investors. I'm sure that's what they meant, but it just said over 3,000 investors. Well, we had over 3,000 investors in Australia. So we started filing in the United States, Qs and Ks, like all the documents necessary to be a public company. And so we were sitting there like, Matt, if we're already filing all these things, like we might as well go public here. Like we're doing all the work. And so we started the process of going public in the United States, which requires typically an IPO, which means you're doing a fundraise. And so we were foregoing, this is like the boom, this post-COVID boom, 2021. Everyone thinks that nothing's ever going to go down. We had over $1 billion valuation, and we were going to raise like $100 million on our IPO. And the IPO just did not go. The SEC was so slow, so backlogged. We were waiting and waiting and waiting. We basically never had our fundraising around.
All right.
And then the markets crashed. I call it techpocalypse,
Yeah. So this was what, like 3 years ago, whenever it was.
Yeah. The markets crashed. So this is another wild ride for us. And what we decided we had to do was we were burning $70 million a year at that point. And I looked at our runway, and I mentioned like I like to have 3 years of runway. We probably had like 16 months of runway. And I was like, that does not feel good. And so we said, forget it. I mean, luckily we were at a good enough scale here. We said, forget it. We got to get to profitability. And I'd never done it before. Like I'd been running startups for 10 years at that point, maybe 12 years. I'd never run a profitable company. We'd always been burning. Like, the ecosystem of entrepreneurship, when you're fundraising, you're just burning and growing. But I was like, we got to get to profitability. And so we did. Within 9 months, we made really hard decisions, and we got to profitability in 9 months. And a lot of it was cost cutting. So we had to cut. We were trying to expand in India, Europe, Brazil. We cut them all. We cut all the expansionary markets. We focused on our core markets. We went from 580 employees down to 240. Massive cut. And again, I don't love that, but I'm just telling. I wanted to tell it to see how people can see how dramatic it was for us. And
How did that make you feel, having to reduce by that much and having to cut people?
Oh, horrible. I never want to do it again. Like I really thought to myself, like, this is a situation I messed up. I should have never got us here in this situation. And I never want to do it again. That's horrible. But I think it was the right decision. In the end, here's how we thought about it internally. If we don't do this, we're cutting 580 people in months. So either cut 340 now or cut 580 in 10 more months. So that's why we decided to do what we did. And I think we've been very transparent with our team along the entire journey, which is another piece of advice I give to entrepreneurs. Be super transparent, as transparent as you can, at least, because people knew what we were trying to do, knew what we had to do. And so I think when the cuts came, it wasn't like they were upset as much as they could have been, because they kind of knew what was happening. And then the real key to this success of this company was it wasn't just the cuts. We invented and adapted, and we launched new products. And so I mentioned the original business model where we were selling to merchants, charging 6% plus 30 cents to get them on their sites. What we realized was a lot of these consumers loved our Pay in 4 product. And they'd always complain to us, Sezzle, why aren't you on Adidas? Why aren't you on Nike? Why aren't you on Home Depot? Get on there. And so we decided to launch a direct-to-consumer product, open loop, where with a card or shopping through our app, we'd allow the customer to shop anywhere. So the first product was called Premium, and it wasn't anywhere. It was the top 300 merchants in the world or in the US. And we did a subscription for $12.95 per month. We opened it up, made it open loop for those top 300. And then 12 months later, we launched Anywhere, which is truly, we gave the person a virtual card and they could go to their corner store. They could go anywhere, the pet store nearby, and just tap, and we split it in 4. And those inventions, what they truly were inventions in the space, they just lit on fire for us. And so we became less merchant dependent with that original business model and more direct consumer dependent. and we just started to take off successfully on the revenue side. So we cut the cost down, the revenue side started taking off, and then we got direct listed, which is another funny story. I mean, in a way, like behind the scenes are funny, like a little bit stressful but funny. We direct listed on the NASDAQ, and because we didn't want to IPO. Here's why we didn't want to IPO. You'll get it quickly. Our market cap was 35 million. We went from $1 billion to 35 million. And the company was actually improving. But when you're that small, no one even cares about you. In public markets. They don't even like look at your reports, even though we're putting out reports.
Yeah, no brokers are covering it. Yeah.
Totally. They won't even talk to us. They won't even take a call. So we decided just, field of dreams approach.
So how long ago was this?
This was 2023.
Right.
Yeah, August 2023. We finally direct listed NASDAQ. So the goal was to clean up the company. Like all this was clean up. Part of the cleanup was we'd already been doing filing in the US, get listed in the US, and we can delist Australia to pull everything. So we look normal, to everyone. Because when you're Australian listed, but US based company, you kind of look weird. So we wanted to also make ourselves look normal.
But since then, you've 100x since that point.
Exactly.
In the last 2 years.
Exactly. It's been wild. We called it the field of dreams approach internally. If you build it, they will come. keep on building, keep on succeeding. And I still remember, so we direct listed 38 million market cap. We didn't even have enough shares to trade. So NASDAQ halted us. We had to move shares over from Australia to make it work properly. We were halted for a month. But no one was really noticing because we were a nothing company. And then we went to our first investor meeting. I remember it was KBW, the investment bank in New York. We met one person, not even a fund. No funds wanted to meet us. We met one person on that. And then we just kept on doing it. We kept on just, got the pickaxe out and just kept on chopping away, kept on doing what we should do. And slowly we gained more traction and got more momentum and started to get out.
And was that building more products, or is it that kind of B2C product taking off and lifting off?
Yeah, it was some building new products, but also the products were taking off at the same time. And then I go into these meetings, Matt. It was funny, like back in Minneapolis, or I'm in Minneapolis now, but our first probably major investment fund meeting, I still remember it. I walked into their offices. They had no idea who the hell we were or who I was. And they're local to Minneapolis. And that's where our company's based. And I sat in their meeting and told them about the business. And they were buying our stock as I was talking to them. They were like, what the hell is this? This is awesome. They were like, this is a gem. Walked right into our office and they bought shares right away as I was explaining the story. And that's when I think the momentum started. Like, because they bought. And so at that moment, when people are buying our stock, we were so thinly traded, it would move it. Like, it would move it. And then they'd talk to the next fund, moved it. And when they was starting to move up slowly, and so it was starting to work. The field of dreams approach was starting to work. And then that was basically it. We just kept on producing, hitting good quarters, good quarter. We got a fantastic team. So we dug ourselves out of this huge pit of missing a big fundraising window, almost going BK, quite frankly, if we didn't do the changes we made, and then launching new products and creating another success story, which is just wild.
What do you see as because the buy now, pay later market is quite small compared to other types of commerce. Do you see that continuing to grow as some kind of time goes on?
Totally. I think we're the best designed for this growth. I think our direct-to-consumer system is so spot on. We still have our merchant business, the original business model where we sell to merchants, but the direct-to-consumer business is going so great. And I really just kind of view this as like a new way to pay. So the debit and credit was the old way to pay. And it's basically just driving a wedge into that payment pie. And here's the reason why. It's customers, these tech customers typically like to pay with debit because they like the certainty and safety, but they want purchasing power. They just don't like to pay with credit cards because they don't trust themselves with their credit card. They think they'll overspend, they'll build up a balance, which is probably true, and then they can't make the full payment, and now they got a revolving balance, so they don't like to use their credit cards as much. With us, there's certainty of payment. It's going to get off my books in 6 weeks. It'll be gone. And so we cater to this unique crowd that just likes that way to pay. And I think the pie is still expanding. And I think it's going to expand for the next 7 to 10 years still. And so we're one of these like 5 major companies going after this space in the United States and Canada, where this payment pie is creating a tailwind for us for the next 7 to 10 years.
So in that period, is it very much just trying to service that market as much as possible, or have you already got ideas and plans of kind of new innovative products you want to launch?
Yeah, we're doing both. So
Yeah.
grow the existing business, keep on innovating within it, like minor tweaks or minor product additions that make it better. But what we're also doing is we're launching ancillary or adjacent products that we think can be big hits. But of course, like a lot of companies see that's not as easy to do. That's not as easy to do. But when you do it well on one of the products or it works well, you get a big boost. So our viewpoint is this on BNPL, on Pay in 4. The customer, when they use Sezzle, they think of it as a financial tool, but they also think of it as a shopping tool. So what we're really building on are the shopping tools. Like price comparison, speedy checkouts, couponing, those types of tools, wish lists, things that really help the customer think about shopping as a way to get more engagement. And we also launched an earn tab because we have mid to low income customers. They're always looking for a way to make $1. Like, here's some other ways you can make $1. Hop in the earn tab, and there's a bunch of different directions you can go to, make a few bucks to make your next purchase. And those have been working well for us. And my view, Matt, is I'd be curious of your view on this, but I kind of view it as like innovator's dilemma. The moment you stop innovating is the moment you start dying as a company. You just got to keep on going.
Can I pivot to a slightly different area around financial literacy? And like you mentioned, I think at the beginning about when young people are got their first job, they've got no credit history. It's harder for them to take out more conventional types of loans and credit and so on. Can you talk about how you're helping that kind of group of people?
Absolutely. So I think first of all, BNPL, Pay in 4, is a far superior product and a credit card for this customer for their first credit product. The reason I say that is because it's safer. So if you make a couple of purchases, let's say you make 3 purchases in a hurry and you overextend yourself and you fail to repay on one of those payments, we stop the customer from making their next purchase. They can't keep on building up the balance. And then how do they fix it? If they fix it fast enough, there's no fees or anything like that. But if they take on a fee, they can come back and fix it. They've got to catch up and get current. And then the product is opened up again and they can use this again, which is almost, to me, it feels like a training wheels. Like the person has had to kind of figure out, I got to pay back to get this thing to work again. Where with credit cards, they can just keep on overspending up to probably a much more inflated limit.
And keep paying the minimum payment every month. Yeah.
Exactly. So I think this is a much better product for the customer. And I think in some ways the customer recognizes that they feel safer. So that I think first and foremost, the product itself is a really good tool for young customers. But number 2, we are unique in the space in that we're the only player to offer the ability to report on your credit file with our product. We call the product Sezzle Up. So if you join Sezzle, you go through a checkout, or now you go through an ad, and you join Sezzle, we don't bug you about Sezzle Up the first time. It's on subsequent checkouts. We ask you, hey, or maybe in our app, do you want to join Sezzle Up? It's free, and if you join it, opt in, we can start reporting your activity to the bureaus to help you build your credit score up. And the main reason we did that is none of our competitors were doing it. And I view this as a young customer, mid to low income. And I was thinking to myself, if I had an 18-year-old kid, if we didn't have this, I would tell them not to use it. And I feel like that's so disingenuous. If you built a product that you would not even tell your own kid to use, that kind of feels gross to me, quite frankly. Like you got to have something that you feel good enough about the product you want to tell your kid to use. And so we thought, let's launch Sezzle Up. Now we can recommend it to our own families. Use the product because you can build your credit score up. And that's been a big hit with customers because it's free. Like a lot of the credit building tools out there are not free. You got to pay something like $20 a month. So that's a nice one, I think, for financial literacy, financial inclusion, financial education. It really does hit on a lot of fronts.
So since the founding of the company, which was nearly 10 years ago, or just under 10 years ago, it's been quite highs and lows in the early part of that. And in the last couple of years, it sounds like it's been very consistent growth with, you've got a very good plan, you know what you're doing, it's about executing and continuing that innovation at the same time. So kind of looking back, what would you say were some of the key things that you've learned during that period?
Wow. Well, first of all, I think the team is the most important part of a company. They call it a company for a reason, a company of people. And I think you've got to be really good at hiring. You've got to be really good at performance management. And you've got to reward your team. You got to let them get the big wins so they can become financially independent in their future. I always kind of view it this way. When you have a big success at a company, if you're a founder, do you want to have the celebration party by yourself? Or do you want to have it with your team? Much better party if everyone's winning. So we always gave equity to the point where we create a lot of wins for people. And we've always had really good retention in our company. And I think that's been the most important part about building this company, is having an incredible team with strong retention and with really high standards for hiring. And that's been nothing but, I'd say, the core principle that's got us through a lot of this.
And are you still involved in all the hires, or or have you created the type of people that you're looking for, and the people you've hired are then looking for those people as well?
I still sign off on every hire. It may not happen forever. As you get a certain scale, you don't. But here's the reason I do it, Matt. So early days, as a founder, your culture doesn't always carry to every area. Maybe my mistake not explaining what we want. But I always liked hiring for potential with lots of talent and lots of ability. And I just had high standards. So for instance, I'll give you an example. We had these hiring channels where I had to approve. We had a developer come through one of the hiring channels, and the guy was 22 years old. And everyone's writing their feedback. Oh, great person. I love the way he described his approach, blah, 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 blah. It was all soft skills, all discussion. And I was like, hey, where's their transcript? It's they're 22 years old. Do you guys want to have their transcript? Please go back and get their transcript. And we didn't have this formalized at this point. They got their transcript. The guy had C's and D's in software development. And I told the team, think about what you're basically asking me. I wouldn't even want this guy in my project in school, but you want me to pay him. No way. Hire is not okay. And so I wrote a big document about using data, which I think is the approach to almost every part of business, but using data. And what we wanted to do when we were hiring at this point for the majority of the roles was, actually every role has some sort of data element to it. But say this engineering role, what we do now is we give everyone basically an IQ test. And then we also require, I don't care what age you are, I want to see your transcript from college. Undergrad transcript, I don't care. And I'll tell you the reasons why we use these 2 data points. We want to hire top 10 percentile in both. And the reasons why, and if there's one system you kept and told me, you can only keep one system in place, Charlie, as you grow this company and you got to walk away for 10 years, I would keep this system. So the reason being, top 10 percentile IQ tells me you have horsepower. There's horsepower, but that's not the only game, because there's plenty of people that have horsepower that are super lazy or jerks, etc. And then so the next part, GPA, that's probably the one I think is actually more important than IQ, because GPA, if you're top 10 percentile GPA, you get projects done, and you get them done well. And more important than getting projects done well, you even got projects done well that you didn't like. There's plenty of classes you had where you didn't even care about the subject, but I just got to get an A. This people that are scoring that high. And so when we started implementing this format, we started just hiring superstars. And then the last element, are they a jerk, which is really important. Are they fun to work with? You can't figure that out in an interview. No interview or interview sequence is going to figure that out. You got to figure it out on the job. And then that's the third element, the EQ part. And then you can, if that doesn't work out, then you let the person go in 3 months or whatever it might be. And then what we basically found is we just started hiring superstar after superstar after superstar. And that's really helped us kind of carry the day and carrying the company forward.
Is there anything else? Like, so team is a big part of that. Is there any other kind of core things that you need as a foundation, and things that you've noticed over in the last two companies, that if you did start another company, you'd be like, okay, we definitely have to do this.
Pick a winning sector. I think too often entrepreneurs are always trying to invent something new. And by the way, that's super noble. And if you do it, of course you're going to kill it. If you're the person that invented Uber, of course you're going to kill it. The people that invented Pay in 4, the Afterpay team, of course they killed it. But if you're the second, they've already proven product market fit, which is probably like 99.9% of where you're going to have problems. And I think a lot of entrepreneurs, the first-time entrepreneurs, they always want to invent it. I tell them, find the sector that's working and jump into it. Because I think business is like a sport. It's fun. So just because some other competitors are in the space doesn't necessarily mean that it's saturated. Actually, it means that you just jumped on a tennis court and you're playing a sport now against someone. You're on the court. And then you can adapt and innovate and adjust. So that's another one I would do. So if I started another company, I would definitely not be trying to invent something new. What I'd probably be doing is watching the ecosystems of what's really taking off and analyze those things that are taking off and launch one of them and just get into the game.
Yep. Did you have any mentors yourself along the way?
I say just my parents, quite frankly. My dad was an immigrant from Palestine, came here at age 26 with nothing. Met my mom at school, and they were a great couple, and they just raised a great family. And my sisters and my brother. I really had no business mentors. It's really interesting because that's usually a common element. But for me, it was really just family. And, I would say there's indirect mentors. I was watching Jeff Bezos. I was watching Elon Musk.
Yeah.
I was watching Warren Buffett and Charlie Munger. These people I kind of idolize, and they're doing really cool things. How do they do it? How do they approach it? What do they say? So I probably had indirect mentorship, but the only direct mentorship was, family, friends.
And because obviously now if you're starting up a business, you've got the wealth of the internet and the web and large language models and everything. There's so much information which was not there, 25 years ago if you were starting a company. Is there any kind of go-to places you would say is worth looking at if you're looking to kind of get into fintech or having a startup?
Oh yeah.
Or people that you follow, you already mentioned quite a few there. Is there like a bedrock of people you would recommend?
Well, if I was going to go after a space right now, and I probably haven't done it justice to pick it really well because I'm just so focused on Sezzle, but I would probably look at how to get into AI, but in a niche. I think the niche always wins. And I know that's kind of contrary to what people are seeing in AI. You see ChatGPT, you see Grok, you see, Gemini. But they're big generalists. They're big generalists. But here's why I say the specialist wins, the niche. I have 2 Teslas now. That's specialist. And OpenAI, you can't drop OpenAI into a car and say, drive the car. There's no way. But the specialist LLM, the AI, it can, because it's been focused on this thing. So I think if I was going to look into getting into a new company or some new attack, I'd probably go into AI and try to find some sort of niche that I found was interesting or maybe untouched and try to drive AI into that ecosystem. Because I think AI really is hot. I just think that it's all pouring into the generalist AIs. Find the niche, go after that, and I think you're going to probably have success if you did that.
So last question. If you were to meet your mechanical engineering self 25 odd years ago or however long it is, what would you say to yourself?
If I had made only one mistake, I'd say start sooner. Go after entrepreneurship earlier. That's it. But it's hard to recreate things because the things that you did helped create who you are. And that first job I had where I met a lot of great people and the bar was low and I didn't challenge myself, that actually kind of created the kick in my butt to make me realize that's kind of shallow. I didn't feel good about my success enough to the point where I'm like, I want to feel good about this. So I think I kind of needed that experience. But I tell people now, age 22, go for it. Go for it. Because I don't know if you have kids, Matt, but one of the hardest things is once you got like a family and kids, it's really hard to do your first startup because you got to put all your energy into your family and your kids. When I had my two startups, they were my babies. I could put all the energy into them, but I was a little bit older. I'm a late bloomer with family and kids. But not a lot of people start as late as I did. So I would start my entrepreneurship journey earlier. That's what I'd say. Start it now.
Yeah,
Just
yeah. You can take as much risk as you physically can when you're starting out. Yeah,
Yeah, and I think people forgive you more when you're an investor and, 22, 23, 24-year-old Andrew, started up and they make mistakes. You're like, oh, damn it.
and it's similarly every time that you fail at something, you're learning from that, and it compounds, and you get better and better. Going back to your climbing analogy at the start, it's all little challenges which you rise above.
Exactly. So start the climb earlier.
Yeah,
Start the climb
exactly.
earlier.
Cool. So Charlie, how can people follow you or reach out to you? What's the best way?
Oh, good question. Probably LinkedIn. Or, it's funny, I'm not a big active social media person, quite frankly. You could email me. It's a pretty obvious email. Just first name, last name at Sezzle. But you could also get a hold of me on LinkedIn, probably more than anything. And but I'm generally not on social medias. I feel weird, when you're in a public company. It's a little bit. I want to be a little bit more private with myself. No doubt.
Yeah, you're not the Elon Musk style of social media.
No, I'm not that. I don't know how these guys do it, honestly.
Yeah.
They really want to be out there. I think even myself, my personal, here's one weird thing. People would kind of doubt this. I don't love being in the public. I don't love doing presentations and, even doing this. This is fun talking to you because I view the podcast as more fun because it's just like a conversation. But I'm not a big, get out there and pontificate. And I think social media is the same way for me. So, yeah, so I'm a little different.
Okay. You'll get lots of emails then.
All right.
So Charlie, CEO of Sezzle, thank you very much for joining us today.
Thanks, Matt. Really appreciate it.